My name is Michael Carbone, and in this video, I'll be reviewing the long-term historical risk and return that investors have been able to earn over the last 3 decades through investing in companies that have historically increased their dividend over time, by companies that have paid the highest dividend, and then finally by investing simply in the market and not paying much attention to whether or not a company pays a dividend or not. All right, so the three proxies that I'm going to be using to represent the different types of companies or the different types of investment approaches are what you can see on the screen. So I pulled these directly from the Standard & Poor's website. I'll be using the S&P 500 to represent the dividend agnostic companies or approach to investing. The index will have companies that pay dividends. In fact, I think it's something like 80% of the index, or at least today's index companies do pay a dividend. But the point is that it's indifferent between whether or not a company pays a dividend, increases a dividend, lowers its dividend, cuts its dividend, doesn't pay a dividend. It's dividend agnostic. That's what I'm referring to it as. And then to represent the companies that have historically increased their dividend, I'm using the Dividend Aristocrats Index, which is a subset of the S&P 500 index. It has the companies in there that have historically increased their dividend over long periods of time. And then finally, the High Dividends Index is also another indice that the Standard & Poor's manages, and that's also a subset of the S&P 500. So it has the same companies that are in the 500, but it's excluding companies that don't meet its parameters. And so, as the name implies, the S&P High Dividends Index will have the companies that have historically paid the highest dividends over time. All right. So on my screen, what you can see this is the S&P 500. That's the bluish purple line. I'm going to refer to that as the market. The yellow line is the high dividend companies, and the white line is the dividend growth companies. And so, as you can see, over their long run, over the last 3 decades, the dividend growers have largely outperformed both other indices. This is over a very long period of time. And so the purpose of this video, and what I'll be reviewing moving forward, are the different periods in time that likely led to this. Then we can draw some conclusions about whether or not that makes sense, and whether or not it may be a helpful information for someone to use when allocating their portfolio based on what they're trying to accomplish with their money. All right, so let's take a look at some of the information that we have available to us. And so what you're looking at in your screen, these are the 12-month rolling returns for the three indices that that I was just discussing. And so what that means in English is that you take the 12-month return from February 1st, 1994 to February 1st, 1995, and then March 1st, 1994 to March 1st, 1995, and you repeat that all the way throughout. And you're doing this as an alternative to just taking the return for 1994 a calendar year, 1995 calendar year, right? Because then you only have 30 data points that you can use, and your chances of having an error, a statistical error, or a sampling error are much greater. And so think of the intuition, or how you can think about it from a standpoint of investing your money. If you invest your money, you're probably not investing your money on every February 1st of every year and no other time period, right? So by doing this, you're just increasing the amount of information that you have so that you can draw more meaningful conclusions. Some key points that I will highlight. If you look to these boxes, these are just summary statistics that I chose to calculate with this information. And so the average 12-month return over the last 3 decades for just the market was 11.7%. The dividend growers, you had 12.6%, and the high dividends are somewhere in between that. Of course, averages will include the extreme periods, and I think that's kind of the point of this whole study, and the conclusions that we'll be drawing. But so the something else I'll point out, this is probably the biggest, the most compelling argument for investing in companies that are have historically increased their dividend, and that's because of the limited, not limited, but the less downside, as compared to more volatile companies during extreme periods. And so, as you can see, the worst 12-month drawdown for the dividend growers was around 23%, whereas the market was almost 38%. And then the high dividends was almost a fully 4% drawdown. And then, on the other hand, on the upside for the high dividends, right, they went down by a lot more, but they also went up by a lot more in the best 12-month periods. But so for the market and the dividend growers, they were kind of similar, with the market going up in the best 12-month period of around 49% and the dividend growers around 48%. But when you consider how much less the dividend growers went down during those extreme periods, there's a lot, or there can be a lot of value in that. So why might the high dividend stocks have gone down by much more in their more extreme periods than the just investing in the market and investing in the companies that have historically increased their dividends? The logical explanation for this would be that if a company has a high dividend yield, right? So that's the dividend that they're paying divided by the market value of the company. If the dividend is a greater percentage of the market value of the company, that means that investors are less willing to pay a higher valuation for the company, right? So you're looking at the denominator of the equation, right? So dividend divided by the stock price. If the denominator is lower, that means that investors are less willing to pay up for that stock, and that may indicate that the stock is slightly or more risky, or the market perceives it to be more risky at least. And so when you have periods of extremes where markets are selling off, investors may be more inclined to sell off a company that they're less certain about, and that company may go down by more as a result. And then likewise, companies that have historically grown their dividend, investors may view them as being more stable, as being capable, capable companies, because they've proved that they can increase their dividends, which are paid out of profits. It may show that they're more disciplined. Investors may simply just feel more confident or comfortable investing in those stocks. So more extreme periods, they may, or they have historically gone down by less. And then you have the market, which again doesn't, it's dividend agnostic. It will own any company regardless of its dividends. It's just simply looking at the size of the company. You have periods where there's euphoria and there are run-ups in stocks that aren't necessarily justified by, the underlying fundamental characteristics of those companies. And so the grossest example of this would be the dot-com bubble, which, I believe is the greatest, explanation for why the dividend growers outperformed over the very long run. If you look here at the dot-com bubble area, which was in the late 90s, you had a big run-up in these tech stocks, regardless of whether or not they were profitable. And so you had investors paying up huge amounts of money for companies that weren't profitable. And, when it turned out that they couldn't turn a profit, right, these companies tanked. And so, again, you've got on the left-hand side, this is the market, dividend growers in the middle, high dividends on the right. So you can see the run-up in the late 90s. You had these annual returns. You were making a lot of money by investing in these tech companies, or just the broad index. You're just blindly pouring money into stocks without regard for any of the underlying fundamental characteristics. And so, if you were investing in high dividends and dividend growers, you're making a lot less money in the late 90s than you were if you were just buying the S&P 500. Now, once that bubble popped, right, when the musical chairs, were filled up and you were the last one standing, you had these company, investors started to pour the money out of these stocks, realizing that it was a bubble, in fact. And, and so you have this period of time where broad investments, largely underperformed investments that had a proven track record of paying dividends, or growing their dividends, and so on. And so this period in time, I believe, is largely to blame for the long-term outperformance of the dividend growth stocks. There was a period of 10 years following the dot-com bubble where you really didn't make any money in stocks if you just had your money in the market and you weren't focusing on specific characteristics of those companies. So the problem with all of this is, of course, that we are analyzing historical data, and the past does not have to repeat itself. In fact, it won't repeat itself. So what we're trying to do is to draw meaningful conclusions about risk and return. And if you're wondering what you're looking at, this is from a blog post that I wrote. I put the link to my blog in the description of this video. But so what kind of conclusions can we draw from this? So for starters, higher dividends aren't always indicative of higher returns. In fact, history shows that a higher dividend yield may even indicate greater risk, as investors may be less willing to pay up for that stock. This may lead to greater volatility during periods of market and economic stress. History also suggests that investors may gravitate towards dividend growth stocks during periods of market stress. These potential risk-reward characteristics may be, may be appropriate for someone that's living off their money if they're looking for, lower volatility without having to sacrifice much in upside. Another drawback to analyzing historical return data that I think is really important to highlight is that studying historical data and living it aren't the same. So, for example, it's really easy to look back at 30 years of return data and say, okay, well, this is what happened, so I'm just going to buy dividend growth stocks because they've outperformed and they've historically gone down by less. But the reality is, if you were to put yourself back in time into a situation where you were making a decision in the late 90s, say, you're gonna look at the market and say, well, if I just buy the market, I'm doing so much better than if I buy these boring dividend growth stocks. It's easy to justify decisions and say, well, something might be different this time. We really don't know. And the point is that we're trying to better understand how markets work, how market extremes work, so that we can make decisions that will, better align with our goals over the very long run. So in summary, this is also from my blog, there are pros and cons to focusing on dividends when investing in stocks. Historically, companies with a strong track record of increasing their dividends have gone down by less during outlier downturns, and alternatively, these types of stocks have historically gone up by less during strong bull markets. Stocks with high dividends as a percentage of stock price may be more volatile during outlier periods. I believe that investors should always consider the potential risk and reward of their investments to ensure that they align with what they're hoping to accomplish with their money over the long run. And then finally, I believe that it's important to always remain diversified, right? We're not talking about buying only dividend stocks and only the market and only high dividend. We're talking about, potentially overweighting or underweighting, certain types of companies. But so I believe it's really important to always remain diversified, as boring as that may sound, and to maintain discipline when you're making investment decisions. Thanks for watching my video. And, as always, if you feel that you would be a good candidate for a complimentary consultation with me, there's a link in the description of this video that you can click and answer just a few questions to see if it may be appropriate for you to set up a call with me. But I appreciate your time. I wish you the best of luck, and I hope to hear from you soon.